You here tonight. The Finance Speaker Series has been around for 12 years. We usually bring 3 to 4 guests in each year to speak on topics that would be of interest not only to the Barron community, but to the broader Erie community in terms of timely topics that, in this case, one that I think is very relevant to all of us as we look going forward. Just a couple of things before we get started. Ben is going to be doing the introduction here in just a moment. With this, I just want to say I am personally thrilled to have George Emanuele here. George is a personal friend. We've known each other, I guess, 5 years, something like that now. And he succeeded me as president of the CFA Society in Pittsburgh this year. So very exciting. But more importantly, from a Barron perspective, is that he is serving as our executive in residence this year. And he has been a great friend to the Black School of Business, Penn State Barron, and he has just been a tireless advocate on behalf of students here at Penn State Barron. So he's a good guy for you guys to get to know, students, talk to. Again, George has been great, very, very helpful to our school. So with that, I'm going to turn it over to Ben, and Ben's going to give us the introduction.
Thank you very much, Dr. Quebec. We appreciate it. It's like you covered a lot about our guests already. I want to thank you guys for all coming out tonight. We have a wonderful guest. George Emanuele is the current CFA Society of Pittsburgh's president, is the current senior director of wealth management at BNY Mellon in Pittsburgh. Today he's here to give us a little market update. If you guys have been following, we're seeing a lot of volatility and a lot of changes in what's going on in our economic markets here. So without further ado, to have George present a little bit on that. George Emanuele.
Hopefully everyone can hear me all right so I can move around a little bit. What I wanted to do tonight was really 3 key things. 1, I wanted to spend a few minutes talking about the markets. 2, share with you our thoughts about the economy. And then 3, tell you what we're doing at BNY Mellon on behalf of our clients. As we sit here today, we're in the midst of U.S. history. That is, we're in the midst of the best bull market ever in stock market history. Let me say that again. This is the best bull market ever in stock market history. And I think that bears repeating because this is the most hated bull market ever in U.S. stock market history. You can see on the slide up there that over the last 10 years, it's the longest bull market ever. It's the second best performing market ever in U.S. history. And I have argued for the last 4 or 5 years now that it's been the best for some time because on a risk-adjusted basis, this has been one of the least volatile markets ever in U.S. history. About a couple months ago now, there was a survey done asking Americans, what happened in the market over the last decade? 50% of Americans said the market was actually flat. 20% thought over the last 10 years the market was down, and only 30% got it right, saying that the market was actually up. We could have randomly guessed a little bit better than what we got. When we sit here tonight in U.S. history, the market has been very strong. I'll talk about October in a few moments, but through the end of September this year, the market continued to remain strong. You can see large caps in terms of domestics, large, mid, small, the blue bar on the chart up there. The market was really strong this year. Double-digit stock market returns through the end of September. Small cap did better. You can see on the emerging market side, right? That was the big loser this year so far in 2018. What's happening? 1, we have a strong U.S. dollar, but 2, we all know there's a trade war going on. China is the largest contributor to emerging markets, and China is clearly losing the trade war. Their currency is under immense pressure, their economy is slowing, and the Chinese market is in bear market territory, down over 20% this year alone. So China is really struggling. You would expect that. Developed international markets down marginally through the end of September. But remember what happened last year. S&P was up 22%. International markets did even better. So you're seeing a little bit of a pause there. But overall, short term, through the end of September, markets have done well, just as we see longer term. Which got me thinking, what in the world do Americans own if they actually think the market was flat or down over the last decade? So I threw this in there and I was wondering, after I saw that survey, what were Americans doing? And you can see the 10-year chart on there. We have a couple things locked off. Certainly commodities over the last decade are in negative territory, down about 6%. But outside of that, every other major asset class that you follow has been positive. So it makes you wonder what's going on. And if you look, I highlighted on the top Treasury bills, up marginally over the last decade. That is effectively cash or money market. Sadly, we still have in this country $2.7 trillion in cash. Just to put that into context, we have a $20 trillion US economy. What happened in 2008, it really bothered investors so much, it starved them so badly, that they'd rather sit in cash and earn very little to nothing, rather than think about the longer term of the market. So cash still sits at record levels. You can see on the chart, if you look at any other major asset class, large, mid, small bonds, certainly made money. It makes you wonder why so many people thought the market was flat, other than they were under or even uninvested in it. So where are we today? For the last 2 years, since November of 2016, we believe we've been climbing to the new stage of the market. We're now at the wall of worry. In a room this size, I think we could all go around the room and name something that scares us about the market. Whether it's a tweet, whether it's what's going to happen to the economy, what about Syria and what's going on over there with that reporter, we can all name something that would cause this market to come down. And that's pretty common. You can see there's a handful here, Fed rate hikes, growing deficits, emerging markets, etc. If you pick any time in US history, you pick the time, you pick kind of the headlines, there are always a lot of worries out there. So what we've done at BNY is we've come up with a filtering process, if you will. We view our job as to filter out the noise. Focus on what's important, not necessarily just the headlines. And if our chief strategist, Jeff Mortimer, were in the room today, Jeff would tell you if you were to cut his head open, he doesn't have a brain. This PowerPoint is really what exists in his head. 30 years of studying the US stock market and looking at various cycles. And some people refer to it as a clock. Some people refer to it internally as a wheel. And here's the way you read it. That outer rim, that's really, think of that as the headlines in the Wall Street Journal. That's the verbiage. I have 9 o'clock blocked off because we are at 9 o'clock right now. Capital expenditures and profits accelerating, right? 2 headlines that you're hearing about. Profits are at an all-time high in the U.S. Earnings are growing north of 20% this year. Capital expenditures, right? After 10 years of a bull market, capital expenditures are actually increasing. So from a standpoint, we're firmly at 9 o'clock. That innermost rim, if you will, or the next rim in, euphoria at the top, fear at the bottom. That's individual investors, right? Individual investors, you always hear this. I like to buy stocks when they're low, and I like to sell them when they're high. Everybody says that. But what do individual investors really do? They love to sell when stocks are high, and they love to sell when stocks are at their low, and they love to buy when they're at their high. It happens every cycle. When you look at individual investors that have been out of the market, when do they get back in? When their next door neighbor says, "Can you believe I made 400% in the market over the last decade?" Oh, really? Maybe I should do that. And they jump in, and euphoria gets to the top, everyone starts buying stocks, and then all of a sudden they said, "Holy crap, I lost 10% in 10 days, I can't take this anymore, I'm selling." And they sell at the worst and buy at the worst time. So that innermost rim, 9 o'clock positive bias, we view that innermost rim as BNY Mellon. We filter out the noise. Where do we want to do? What do we want to be doing with our clients' portfolios? And what I love about BNY Mellon, and this is by no means a sales pitch, is our portfolios at 9 o'clock and 12 o'clock look dramatically different. At 9 o'clock, we have a positive bias. We are positioned our portfolios of growth over value, because growth should do better in this environment. We're positioned for domestic over international. And the key thing at 9 o'clock is you always want to buy the dips. We're climbing the wall of worry, right? We went to 9 o'clock on our wheel a couple days after the presidential election in 2016. We're firmly still there. A 9 o'clock in U.S. history has averaged 22 months. We're now coming up on 24 months. That doesn't scare us because remember we said we're in the longest market ever. This can certainly last much longer. The longest 9 o'clock reading in history has been 41 months, so maybe we have a couple more years to go. A 9 o'clock is typically a very good market, but it is very choppy because of the wall of worry we're climbing. How does a 9 end? It ends one of 2 ways. We either go to 10 o'clock or we go straight to 12 o'clock. 10 o'clock market, grab the side of your kayak because what happened last year in the markets will certainly happen again. 1,000 called 25,000 today. We would easily get to Dow 40,000. Would take very little effort to get there. If instead we go straight to 12 o'clock, standard US recession, market pulls back 20%, or underwater, if you will, stocks are down for anywhere from 12 to 18 months before you regroup. What I love about this wheel is most people are so always worried about 12 o'clock, right? I don't want to be there when the market goes down. But here's the reality. If you're in a portfolio that's well diversified and you stick to the plan, you typically make up almost all of your downside in one good quarter. One good quarter makes most of it back. Now, certainly that didn't happen in 2008. The 2008 was once in a lifetime type of event. So this is our wheel. This is how we filter out all the noise and focus on what's most important. Look at what moves you from 10 to 12. Rising inflation and rising interest rates, right? So we're in the midst of a bull market. In every bull market in U.S. stock market history has ended for one of four reasons. Go into a recession, you get inflation, you get a stock market bubble, or the Fed becomes over aggressive. So let's take them one at a time. U.S. recession. There's no sign of a U.S. recession. We don't think we have a U.S. recession until at least 2021 here in the U.S. When you think about the three key levers of the economy, housing, employment, and consumption. You want to go build a new house, what do? You go get a permit. Once you get a permit, you start building your house. That's the data on this chart. Moving up and to the right. Yes, shorter term with interest rates going up, we're having fewer people build homes, but the housing market is still okay. It's not great, but it's certainly okay. And think about 2008 for a minute. Worst recession since the Great Depression. We have a down market, and the housing market collapsed on top of it. The chart on the top shows you how long it takes you to sell your house. In 2008, people were underwater using their houses for casinos and leverage and all kinds of stuff, buying houses they couldn't afford. And what happened? It took you 4, 5, 6. In 2008, it took you up to 12 months to sell your house. Well, if you have the 12 months to sell your house and you have to get out now, what do? You do the chart on the bottom, you cut the price of the house. In 2008, what did we see? Home prices in this country decreased by 35% on a national basis. Today, home prices are 4% above where they were. Housing market is okay. If you want to put your house up for sale today, take about 4 to 5 months to sell. So no surprise, home prices remain firm. Second key thing for the economy is employment. I have argued for a few years now that the unsung hero of this economic recovery is right there, the unemployment rate. It peaked at 10.2% in 2008. Today it's less than 4%. Just 2 years ago, the Fed told us we'd never get below 5% again. Now we're below 4 and maybe going closer to 3.5 or 3. The underemployment rate, that was always the big argument. When I would give a presentation like this a few years ago, I'd have a line from here to University Park. People would tell me, George, you're wrong. The unemployment stinks in this country. You're dead wrong. What's your argument? The argument was the underemployment rate, right? You go to Penn State Barrett because it's a great school. You want to get a good job, make a lot of money. You get a job at Target making 30 grand a year, you thought you'd be an investment banker making hundreds of thousands. You're employed, but you're underemployed. That gold bar is the U6 or underemployment number. It peaked at 18% in 08. Today it's about 7%, moving in the right direction. But the two key things in the job market right now as we sit here today, one, we've been adding jobs in this country for north of 100 months. I quit counting. But the record, just to put it in context, was 47 months, and that ended in 1997. We're probably closer to about 120 consecutive months. There's a chance we may pass the record twice. That's impressive. The second key thing, job openings in the U.S. We now have north of 7 million job openings right now today in the U.S. That's more than unemployed Americans. In theory, everybody that wants a job can go out and get a job. Now, that's not always true, right? If I lose my job at BNY, none of you would hire me to be a mechanic, or at least not kill me the next day. So the reality is not everybody can get a job. But for the first time in 17 years, more people could get more job openings than unemployed. So that is huge. Employment's moving in the right direction. And of course, the most important part of the economy, it's everybody in this room, right? It's retail sales, consumption. 2/3 of the U.S. economy is us spending money. You can see there retail sales moving up. 8 consecutive months, the retail sales in the US have in fact gotten better. Retail sales have been very strong. But here's the main part. Nobody cares in finance what happened last year, right? What's important about retail sales? What's going to happen next quarter, year after? And you need 2 things in order for retail sales to remain strong. First is we have to have money, right? If Americans are wealthy, they'll spend money. We said the stock market's at an all-time high. Check that box. Home prices for most Americans, it's the largest asset. Home prices are now highest ever in U.S. history. Check that box. We said more Americans are working now than ever before. And we haven't talked about wage growth. We're now getting real wage growth in this country for the first time in a very long time. Americans are wealthier today than ever before. So we have money. And the second thing you need is you have to be confident. If you're not confident, you're probably not going to spend money. The chart on your right shows you consumer confidence. Consumers are effectively the most confident ever in U.S. history. Once before, we were more confident than we are today as a consumer. So if you have confidence and you have money, you're very likely to spend it. We think retail sales continue to do well. Take a look at the chart on the left. Small businesses. Small businesses are the most optimistic they've ever been in U.S. history. No surprise, small businesses are confident, they're making a lot of money, and what do we say at 9 o'clock? Capital expenditures, right? When they spend money, that's a capital expenditure. Capital expenditures are moving up. So retail sales, the backbone of the country, should continue to do well. 2/3 of the economy, we said, is the U.S. consumer. The other third is corporate America, and corporate America is certainly doing well. This slide here shows you the Institute of Supply Management numbers. Comes out as a monthly survey early in the month. Every month you get this data. It's a very simple chart to read. It's known as a diffusion index. So above 50 is expansion, below 50 is contraction. Take a look at where we are. Right, the 10-year average is 53. Today we're at 56. When should you get worried? If we're below 50 for 2-3 months in a row, we're probably getting close to entering a recession at some point in the future. We're nowhere near. Over the last 10 years, we've averaged 53. We're well above that. These are really, really high readings for the ISM number. Corporate America is doing very well. So far, we've only talked about the U.S., right? The U.S. has certainly been a very strong market, but we're now a global market. What happens in the U.S. is important, but we also have to pay attention to what's going on around the world. And when you look at what's going on around the world, the Purchasing Managers Index, much like the ISM, the Fusion Index above 50 is expansion, below 50 is contraction. Look at where we are. We're still well above 50, 53. Yeah, it's pulled back a little bit. Trade war, stronger dollar, some things going on. But at the end of the day, 53 reading is very good, and you can see prior to just a couple months ago was one of the highest readings we've seen in the last few years. So at the end of the day, corporate America also doing very, very well. That being said, if you want to know when the bull market's going to end, right? When does the bull market die? You don't ask the stock market, you ask the bond market. The bond market is a lot smarter than the stock market. Bond investors don't get much notoriety, but the bond market tells you where the stock market is going to go well before it does. This chart here is the yield curve. It's very simple. Interest rates short term, all the way up to long term, and what you would receive. Typically, the yield curve is upward sloping. So if you have a short-term deposit, you get a few dollars, you get a lot more if it's a longer term. When the yield curve inverts, when short-term interest rates go above long-term, probably heading into a U.S. recession 12 to 18 months away. We are at the purple line. So the yield curve is clearly flattening. It's clearly a concern. But what we've done here on this chart is we've done the math for you. The chart on the top shows you the 2 and 10 years. So it takes the 10-year treasury minus the 2-year. If the 2 year is higher than the 10-year, then the line would be below 0. We have an inverted yield curve. We're not there. Look at the 10-year in 3 months, another way of looking at it. Certainly not below 0. You can also look at the 10-year and the Fed funds rate. Some people look at the 30-year and the 10-year. There's various ways of looking at an inverted yield curve. A couple of years ago, the Fed came out and said they've studied all the yield curves. The 10-year 3-month yield curve is by far the best predictor of a recession. Every recession since World War II, the 10-year, 3-month inverted and predicted it correctly. There have been a couple of occurrences where the 10-year, 2-year inverted. It looked like a recession was going to happen. It never happened. So 10-year, 3 months, but we certainly watch them all. The bond market will tell you when the stock market is going to be at its end. So you piece it all together, what is a recession? 2 quarters of negative GDP. 2018, we're looking for 3% GDP growth this year. I mean, take a look at that chart for a minute, right? We've been in 10 years of an economic expansion. And to use the word best 10 years later seems crazy. But we're going to have the best economic growth this year that we've had in the last decade. 3% is okay. Years ago, coming out of a recession, what happened? The U.S. economy would grow 4, 5, 6, 7%. That's not happening. We're having slow growth. We can talk about theories on why maybe that is. But certainly, 3% is better than the north of 2% we've averaged. So I told you this is the best bull market in stock market history. Here's the sad news. This is the worst economic expansion coming out of a recession in U.S. history. Slowest economic growth coming out of a recession yet, the best bull market. Part of that is because of how hard the market stole out. Next year, 2019, we're looking for about 2% growth. Again, that's in line with what we've seen over the last 10 years prior to this year. 2017, we back up for a second, our theme coming into the year, global synchronized economic growth, right? Very rarely in U.S. history do you have all economies expanding. 2018, the calendar year changed, but our theme really hasn't. We still believe there's global synchronized economic growth. When you look at this chart, virtually every major economy around the world is expanding. I will tell you there's the fewest amount of countries in a recession, I think, ever in world history right now. Almost all countries are expanding. So global growth, it's not just the U.S., all tides are rising, which is certainly good for everybody. So the first reason why a bull market dies is a recession, because of housing, employment, consumption, the ISM numbers. You can look at other things that we didn't talk about. I'm signaling a recession. Second reason we said is when the Fed inverts the yield curve, it's getting closer, but we're not there. The third reason why bull markets die is inflation, right? We said consumers 2/3 of the economy, inflation goes up, we all have less money to spend, earnings go down, valuations go down, and the market goes down very hard. 5 of the last 6 U.S. recessions were either caused by or exaggerated by inflation. If you think about our real, what moves you from 9 to 12? Inflation is one of the most important variables we follow. When you think about inflation, you get inflation a couple different ways, right? You get price inflation, but it's hard to get price inflation in this environment because there's a small company called Amazon. And once you raise prices too much, Amazon comes in and starts selling all of those goods for you at a much cheaper price. So there's not much price inflation. Wages, I will acknowledge there is wage inflation. You work, wages are going up in the U.S. about 3% on a year-over-year basis. The death number becomes, you don't want to go above 4%. Corporate America can't take that, profit margins go down, they can't pass that on. So we're moving up, but we're not, if you will, at the 4% number. And then the most important one to watch is energy prices, right? Energy has been one of the main reasons why the U.S. economy has gone into a recession. You can see the oil chart up here. A few years ago, oil was $120+ a barrel. Certainly fell hard. Last year at this time, oil was about $20 a barrel. Smart people like Goldman Sachs and Citibank said it was going to 10. We think oil's worth $50 to $70 a barrel. We said that a couple weeks ago when it was 80. We said it was 20. That seems to be about the right price. North of 100, closer to 120 for an extended period, could cause inflation and end this market, but we're nowhere near those types of levels. November 2016, when I started talking about inflation and things that could end the market, I had to add a new slide in here, right? I never talked about tariffs before in 20 years of doing this. But we now have a new type of inflation that can speak out there, and that's tariffs. So let's talk about tariffs because it is certainly a hot topic. Tariffs could lead to inflation, but here's the key thing, and here's the way we frame it. The U.S. economy was solid before we got tax cuts, before we had any type of tariff talk. We got tax cuts that were north of $1 trillion of stimulus to the U.S. economy. That's on the right-hand part of the slide. What about the tariffs? The tariffs are going to impact the U.S. economy by anywhere from 120 to 240 billion. So there's a net benefit of 4 to 1 or 8 to 1, depending on what it costs us, of tax cuts over tariffs. Tariffs get a lot of talk. They should be concerned about, but certainly maybe not as fearful as if you watch CNN, Fox, and CNBC all day. They would make you believe that is the only variable. The US economy is more than solid enough. $20 trillion economy, and the $100 billion net negative, it's very, very small to the overall size. When you look at inflation, inflation numbers are in check. Right now, even after QE 1, 2, 3, and 4, Operation Twist, all the stimulus the Fed and global governments have done, we're barely at 2% inflation. You can see both the core and the headline number. Core excludes food and energy, because those, as you probably know, can be very volatile. You get a drought, food prices go up. You get a hurricane, energy. You look at the blue line, it's a bit more stable, or right around where the Fed wants to be. So certainly no sign of runaway inflation. We said the bond market's the smartest market in the world, so if you want to know where inflation is going to go, ask the bond market, it'll tell us. You can see on this slide, 10-year Treasury minus tips, that is the implied volatility that the bond market is expecting over the next decade. We stand here today, the bond market is telling us, even despite all that we've done to create inflation in the US, only expect about 2%. So at the end of the day, inflation is likely to remain in check. No sign of a recession, Fed over aggressive, or inflation. The fourth reason we said bull market side, valuations get too heavy, market becomes too frothy, the music stops, and the market goes down. 1999 was probably the best example, recent example of this. Look at valuations, right, on an inflation-adjusted basis. So if inflation, we said, is just over 2%, when inflation is between 0 and 4%, what's the right multiple for the market? Somewhere between 17 and 18 times price to earnings ratio. Right now, today, based on where earnings are next year, market's trading at 15 times. The market's trading at a discount because we got a bit of a pullback here the last few weeks. So valuations seem reasonable on an inflation-adjusted basis. Of course, there's two components to the price to earnings ratio. Price is the market, that moves every day. Earnings is the denominator. And look at earnings, right? Here in the US, we had 3 years in a row, 2014, 15, and 16, with an earnings recession. Earnings grew effectively 0% for 3 straight years, yet the market went up. And that happened because valuations were so cheap. The investors were still so scared from 08 that stocks were still undervalued. Last year, we saw pretty nice earnings growth. 2018, we see earnings going from 133 to 155 to 160. Now, just to put that in context, we started the year off at 150 to 155. We've since raised it to 155 to 160. And the answer is we're probably still too low. It's probably going to be north of $160 of earnings for the S&P this year. First quarter grew at 20%, second quarter grew at 25%, third quarter, only half of corporate America reported. We're growing around 22.5% earnings year over year. Fourth quarter is expected to begin around 18 to 19% earnings growth. So earnings remain strong, and as you probably know, so goes earnings, so goes the markets. It's by far the most important thing. When you look at this slide here, valuations, right? We said forward basis, you could get 17, 18 times earnings. Well, if you look at current valuations of the market, we did 18 and 19 here on 155 and 160. Next year, the S&P is going to earn likely 170 to 175. If you take the midpoint, say 172 times a 17 or 18 multiple, you're looking at north of 3,100 on the S&P versus 26 and change today. S&P, based on earnings, is clearly, in our opinion, undervalued given the recent correction we've had. So goes earnings, so goes the markets, right? That's the theme. In US history, we've only had 15 markets where earnings have grown 20% or more in a calendar year. 2018 is going to be one of those years, very likely, given that 3/4 of earnings are virtually in. Look at US history. What has happened when earnings have grown 20%? 11 of the 15 times, the market grinded higher the next 12 months. One of the exceptions, we were in the midst of a war, so maybe you throw out that 1 year, but in that part, that year was down, of course. But other than that, markets usually follow earnings. Earnings are very strong, and where valuations are, we think market does well. One of the things I love is every time there's been a correction over the last, really, I would say 8 years now, what has happened? You get a pullback in the market, individual investors get very scared because one of my favorites was the US government shutdown, right? The market went down 18% in 12 trading days. We were all going to learn how to speak another language. It's the end of American civilization. As we know it, sell all your stocks to move. That's what Americans were pricing into the market. Of course, 18 days later, 30 days later, the government opened, market hit all-time new high. What was corporate America doing during that time? CEOs and CFOs were buying back record amounts of stocks. They were saying, if you're crazy enough to sell me that stock for that price, I will buy it from you. That happened during the tsunami/earthquake/nuclear meltdown in March of 2011. It happened later that year when the government shut down. It happened in 2016 in Brexit. It happened during the presidential election in 2016. It happened during the China slowdown. Earlier this year, we had a first 10% correction that lasted more than a handful of days. First quarter of this year was a record amount of share buybacks. Why? Because of this chart. Corporate America has pristine balance sheets. If you look at debt to equity in corporate America, they are way under levered. The debt that they do own has been refinanced at very, very low rates, and they're printing tons of money, right? Corporate America is making tons of money, even though they're hiring more people, increasing wages, increasing capital expenditures, their cash flow keeps going up. So every time their stock goes down, they buy it. I'm a firm believer that page C1 of the Wall Street Journal in the next 3 weeks will read, corporate America buys back record amount of stock in November of 2018. Same way they did in February of this year. Corporate America is saying, if you're going to take my stock from 220 to 200, thank you. I'm going to buy it from you. It's happened every single time. No, since 2008, we've had 62 stock market corrections over that time period. 62 of at least 5%. 8 of them turned into double digit, 10% or more, never 20%. So here we are again, north of 10%. Second time this year, I think CEOs follow suit exactly what they did in the first quarter. Volatility, right? When you talk about the market, sadly, everybody wants to talk about, oh, the stock market sold off the last few weeks. As I said, we try to avoid the noise, but I knew I had to talk about it since we have a group this size. Let's talk about volatility in a couple ways. Let's talk about one, why does this stock market correction feel worse than what we've seen in the past? I think there's 2 key reasons. One, think about Brexit, or think about the presidential election, right? Market pulled back. By the time you figured out who was president of the United States, stock market was making an all-time new high. By the time you figured out how to spell Brexit, stock market was making a new high. Right here we are, the stock market's been down for 3 weeks now. My God, it hasn't made a new high. But let's just put it in, so that's one reason. The fact that this isn't over in a week like virtually all the corrections over the last few years. And number 2, we've had virtually no volatility in the market. I know most people feel that there's a ton, but we've had almost none. Last year was a record level low of volatility in the US stock market. I think it was the lowest in like 90 years or 70 years or some crazy number. There's been no volatility, so when you get a little bit, you think it's the end of the world, but it's below average. This chart here shows you the VIX, the Volatility Implied Index. Today it's north of 20, but we've been sitting well below 20. As a matter of fact, we made record lows multiple times last year. Above 20, there's fear in the market. Below 20, there's complacency. We've had way more complacency than fear. So the first reason is this market hasn't fixed itself in a week. The second is, go from June 25th of this year to October 5th of this year. Call it 4 months. In that 4-month period, we did not see a single 1% move in the S&P. That's up or down. Market fell asleep for almost 4 months. And what happened? Somebody got a foghorn and woke the market up, and it woke up pretty angry. Went down 6% in 2 trading days. Well, let's put all this into context. Long-term, historically, stock markets average 2 corrections a year of at least 10%. This year, we've had 2 corrections of at least 10%. Completely normal. It's in line with the historic average. We're at 9 o'clock on the wheel. We've gone back and looked at 9 o'clock wheels and said, what does this compare to prior 9 o'clocks? This pullback looks 100% identical. So there's volatility in the market, but no, we've had 62 of these over the last 10 years, and every time we hear them, I call them vampire economists, right? Vampire economists love to call CNBC every time there's a correction and say, this is it, it's the end. And they get on CNBC, and of course the sun rises, they have to go back in their coffin, and we don't hear from them again until there is another pullback. Volatility we've seen has been below average and normal, so no sign that this is over just because the stock market is sold off these last few weeks. Elections. This doesn't show up on the wheel, but I know that I would talk about it. People will ask about it. We always get asked, what happens if this person becomes president? I was asked to be in Emanuele to give a handful of presentations prior to the presidential election. Normally we have well-known people on CNBC and et cetera come in and do it, but because this was the most contested election in U.S. history, we didn't want someone to do it. I was there just to talk about the markets, and the second I was done, every time someone would raise their hand and say, what happens if Hillary Clinton wins? We're going into a recession, right? Now, 2.5% economic growth. Well, then if Donald Trump wins, we're going into a recession, right? Now, 2.5% economic growth or better. We all like to think that the President of the United States is the #1 predictor of stock markets. Certainly they can impact the sectors in different parts, but it's usually not as important, right? When you think about all the various factors out there, it's a lot further down on the list than I want to believe. And this chart is a great example of that. Take a look at the chart on the bottom, midterm elections. I can't tell you how many times in the last month I've heard, well, if the Republicans don't sweep, it's the end of this market, or if the Democrats sweep, it's the 17 out of 17 last midterm elections, market has gone higher. And we've seen in virtually every combination of Republicans sweeping, Democrats sweeping. We like to believe that it's the #1 factor, has a lot less impact than we all think. So certainly we're watching the elections, but not necessarily the key thing. Earnings, inflation, those are the key variables, but unfortunately, these take up more of the headlines than the important stuff. Markets pricing in a probability that the Republicans will keep the Senate, Democrats take the House. That's what the market's expecting based on all the survey data that we see. Who knows, right? The survey data the last couple of elections hasn't been all that accurate. But if that happens, you can see that's in the middle there, the 10.8% likely is what the market does based on that. If you get a sweep Republicans or sweep Democrats, the market's not expecting it. It could be more of a net negative or net positive in the short term, but the market's pricing this in, that's what we expect. And unless there's something shocking, not that big of a deal. And what I love is, after the presidential election in 2016, we did have a few calls. What happened? What happens to Donald Trump? You can't show me this, George. Markets don't average 15%. We've never seen a president that tweets before. We never see. I get all that, but that's a lot of noise, right? The stock market doesn't read tweets. We read tweets. So a lot of noise that we as Americans spend a lot of time worried about, but maybe not necessarily as important as focusing on earnings and the other things. So when we piece this all together, what's it look like? And I do apologize, I am going to read a little bit here. The market still has room to run. The yield curve, we said, is not inverted. Typically, the yield curve inverts 12 to 18 months later, you get a U.S. recession. Interestingly, even after the yield curve inverts, stock market almost always continues to rally higher for that. So you don't necessarily need to sell all your stocks the day it happens, but as we go from 9 to 12 o'clock, right, you want more protection in your portfolio. 2, PMIs, right? We talked about the ISM and PMI numbers. They will tell us when we're heading into a recession. There is a lag time. We haven't crossed below that 50 mark for 2-3 months. No sign of a recession there. We talked about wage growth, right? 4% is the number. When you get above 4% wage growth, the market is probably, earnings are coming down, so goes earnings, so goes the markets. We're getting closer to the end. Didn't talk about this, but when do recessions usually happen? Talked about the yield curve and other indicators, but almost always you see the unemployment rate increasing by 50 basis points. So, unemployment rate called 4% today. If the unemployment rate goes from 4 to 4.5%, probably getting close to heading into a U.S. recession. We're not seeing that. We said we're adding jobs for north of 100 months. Central banks here in the U.S., right, we're raising rates, but globally, China cut their rates by 100%, 2 weeks ago now. Global central banks are pouring money into the market. That is a net positive. The Federal Reserves, knows that if they invert the yield curve, we're almost definitely going into a recession. I know they say they want to continue on the path, but they also know the harm of that. So we think that they want strong language, but we also don't think they're going to invert it. And then, of course, the most important thing, earnings. It's the number one variable in the market, and earnings have, as we said, been unbelievable. So what do we tell our clients? Well, big picture, the blue section is stocks, the gold section is bonds. We're overweight stocks relative to bonds, right? We're at 9 o'clock. At 12 o'clock, we'll be overweight bonds, underweight stocks. We're not there yet. Within stocks, we're overweight domestic relative to the US. That's what we want at 9 o'clock, and that's where we are. I will tell you, right after the presidential election, where it says small overweight and full overweight, mid cap and small cap, we went full overweight. At 9 o'clock, small caps and mid caps do better. That was one reason. And two, we were worried about some protectionism in the market. It's a net negative for GE and Apple. Small cap and mid cap companies, protectionism has very little impact. We have trimmed that back. 3 of the last 4 months between June, July, August, and September of this year, we've been trimming back our stocks. All of that has happened in mid cap and small cap. I personally rebought last Wednesday from everything, all the cash we raised from trimming, redeployed it. If the market's going down 10%, we want to take advantage of that. I know your professors will tell you this isn't true, but I'm going to tell you something that they don't teach you. You always hear in life, right, there's no free lunch. I always tell clients there's only one free lunch in investing. It's rebalancing your portfolio. Stocks go up 22%, you trim your winners, cut back on your stocks, you buy more of your losers. Bonds. When the market goes down, you trim your winners, bonds, you buy more stocks. It's the only free lunch. And we have been doing that and we'll continue to do that. 9 o'clock, you buy the dips, and that's what we're doing. You can see we have some diversifiers in there just to lower the overall volatility. But it's hard to buy bonds here, knowing the Fed's going to raise rates. Bonds are almost guaranteed to go down from these values. So if you think stocks are overvalued, then you absolutely hate bonds. Because bonds, stocks are trading at 15 times earnings. If you look at price to coupon of bonds, they're trading at about 45 times. They're 3 times more expensive than stocks. So it's always funny when I hear clients say, I can't stand stocks, maybe I'll just buy some bonds. Well, let's do the math, because if you don't like stocks, you hate bonds. And let's stay away from maybe just thinking about cash or something else. So let me stop there. I'll gladly take any questions or comments. You needed an icebreaker. Ma'am.
I'm sorry, I'm not sure I can say I'm real clear, but what did you see your strategy was right now? You're overweight
In stocks.
In stocks.
That is correct.
What were you saying about the small and mid caps?
So November 2016, our wheel went from 8 o'clock to 9 o'clock. And at 8 o'clock is when you want low quality stuff, emerging markets, etc. At 9 o'clock is when you want mid cap and small cap. So we bought a significant amount. Most of our portfolios had anywhere from 10 to 25% in mid cap and small cap. And to put that into context, most firms are doing 2, 3, 4%. So we said, hey, 9 o'clock is when you need to buy it. We're worried about protectionism. All roads lead to small and mid. It's been very beneficial, but we've been cutting that back. Because the stock market went like this, but those did even better. We thought we would take some of the chips off the table recently.
And what is your thought on some of the major stocks out of China, like Alibaba?
Yeah, so we typically buy. We do have recommendations on all of those. I don't necessarily have those. I looked at Alibaba for a client about 4 months ago, so I know enough about it to be dangerous. But I try to stick more toward our calls here. Investors love to talk about at tea parties. I own Alibaba and stocks do well. But where do you make most of your returns? 92% or more of your returns are going to be getting your asset allocation right. But we all want to pick the fun, hot stock. It's very, very small part of your total return. So we really spend most of our energy there. We do have analysts in-house to pick those all day, but I'm certainly not an expert on Alibaba versus other. I will tell you, China's under immense pressure. President Xi is going to probably cave here at some point. Been in hiding for 2 months, has asked the President of the United States not to talk about tariffs until the November meeting. It looks like China wants to do some deal. If that happens, China market's probably going to move up. Until that happens, China's going to remain under immense pressure and continue to slow. Yep. Other question? Ma'am.
I have two questions. The first one is, do you recommend the auto balancing tool for many of the 401k plans offered? And also, what is your opinion of the national debt as a rising percentage of GDP?
Yeah. So let's start with the auto balance. I'm a huge fan, right? Because what are you doing? You're trimming your winners and you're buying your losers, right? That's the only free lunch that we always talk about. Because if not, what happens is, I was going to add money to the market, but you know, it sold off 10% in the last 2 weeks. I'm not going to do that right now. We'd rather wait until the market gets high and going up, and then we feel more comfortable doing it. So by automatically rebalancing, forces you to do what's counterintuitive. You're buying what's down, and you're selling what's up. And it keeps you to that glide path. So I'm a huge fan. In terms of the national debt, I am worried about it. You know, I had that slide up there, and I said, worst economic expansion in U.S. history. I believe that's for two reasons. The first reason is the amount of U.S. debt. So the U.S. economy is not going to grow at 5, 6, 7% anymore coming out of recession. Two famous economists, Reinhardt and Rogoff, have written a book on it. It's called This Time is Different. I believe it's chapter 13 of that book talks about when civilized countries have amount of debt, what their growth rate goes to. So the new normal is a couple percent GDP. We're not going to talk about 7% anymore, sadly, because of the amount of debt. I will tell you, every time the Fed raises interest rates by 1%, $1 trillion of expenses over the next 10 years. So the U.S. is in a really tough spot, right? If the U.S. economy keeps heating up and we keep raising, it could lead to some really bad things. I don't know how it's going to end. I don't think anyone does, but I will tell you, in the next 6 months to 2 or 3 years, I don't think it impacts the market, but I think longer term it could have some real impacts on the market. You're welcome. Sir. Oh. That was a cue, I'm sorry. Other questions or comments?
Well, George, could you, because we have obviously a lot of students here, what kind of recommendations would you make for people in general that are thinking about kind of going into this field? What's some of the best things you think they can be doing?
Going into the field of investments? Yeah, I mean, certainly you're all on the right track, right? You're at a great university, check that box. I would tell you, as soon as you graduate, I always say, get an advanced degree, get a designation. Advanced degree could be an MBA, it could be law school, whatever is important to you, but I would certainly encourage you to get an advanced degree. I'd also encourage you to get a designation. CFA, CFP, there are tons of them out there. But I think if you're really passionate about that, I would at a minimum do that. I would also tell you, if you're really passionate about this stuff, you should be doing this in your personal time. It's not just, I went to work today to balance portfolios. You know, in your personal time, you'll be reading investment books and investment newsletters and Barron's and all that stuff. If you're not doing that, you're probably not, you know, this probably isn't the best profession for you. I mean, this is my life. I love it. I live it. Amazon send me books all the time and read nonstop. So I think you have to have that. Otherwise, you'll find yourself just to be okay and not have much of a career path in it. Is that kind of the path? Sure, thank you. Oh, sir?
Do you have any book recommendations?
Book recommendations. So every year, being on we have to take off 2 weeks. And every year, I have a theme. So 2 years ago was asset allocation. This year, it was all about being a better me. So those are the ones that I most recently read. Essentialism was fabulous. Talks about cutting out the fluff of your day and focusing on what's important. I read the book, What Got You Here Won't Get You There. It's a book about if you want to take the next step in your life, in your career, how you have to change, right? Not waiting for your manager to tap you on the shoulder and, okay, now it's time for you to, how do I make myself better, right? I promise you, tomorrow, Jeff is going to be getting a call from me, Professor Coy. What can I have done better? What can I make my presentation better? Greg will hear from me as well. So that you're always trying to make yourself better. If anyone in the room has comments for me, my email's up there, please send them to me. So those are two that I would highly recommend. The other one I like, the first 50 pages were rough, was Extreme Ownership, written by 2 Navy SEALs. And the book was broken into 3 pieces: what the Navy SEALs training was, what their mission was, and how you apply that to business. So each chapter was kind of 3. It was really, really interesting. And it just talked about how you take ownership in everything you do. If someone else failed, it's not their fault, it was your fault. You didn't communicate it effectively, etc. So those would be my top 3. Now,
What's your view on
cryptocurrency. So being unknown, we're not a fan at all in terms of investment. One thing is there's no transparency with it. So if you want to buy a nuclear arm from North Korea, you can do that with cryptocurrency. When something goes bad, the cryptocurrency is going to have transparency, which I believe will shut it down. So without any type of regulation, without any type of who's doing what, probably has no real value other than a speculative value, and you can't predict what that is. The technology itself is going to change the world, right? Blockchain is here to stay. That's going to be used, but in terms of an investment, we would stay away from it. We haven't touched it, and I don't know how anybody can value it and what value anybody sees in it, but a lot of people are buying it, so. That's a great example of a 12 o'clock, right? The euphoria got so high, everybody had to buy it at 20,000. Now it's at 6, nobody talks about it. Yeah.
I have one more question.
Sure.
You were saying that earnings is so important to the market overall. Can you explain when something like Netflix has really great earnings in that, and the stock will go up $60 overnight, and the next day it's below what it opened at? Talk about that kind.
So when you think about the markets, it's really about expectations. So let's say Netflix, in your example, is expected to make $10. And they come out and they make 9, but they grew earnings. Last year they made 6, this year they made 9. Wow, that's huge. But the market was expecting them to make 10. So they missed expectation. The market was already pricing in 10, and they only got 9. So the market has to adjust the price for that new information. And that's what we've seen. More recently, we've actually seen, believe it or not, companies beating earnings. So this quarter here, 50% of America has reported earnings. 77% have beat earnings. 5-year average, 71%. So more companies have beat. They've beaten by an average of 6.5%. The 5-year average is 4-point-something%. So most companies are beating, but we know over the last 3 weeks the market's down. Why? In that example, it's just because people are frustrated, right? Maybe it's the midterm election. Maybe it's what's going on in Saudi Arabia. Whatever the case may be, these happen all the time. Government shutdowns. Emotions take over rather than earnings, but earnings will drive the stock higher as long as it's better than expectations over the long term.
And what is your feeling about buying right before earnings?
You know, there's only 4 days a year that the stock price makes any sense at all, right? Those are the 4 days a year you report earnings. The other 361 days, the stock price is kind of meaningless. Warren Buffett always says that we should open the stock market about 1 hour a year. Kind of get a feel for what stocks are worth and then shut it back down. Nobody in the room would go for that. But the reality is, those are the only 4 days a year that earnings matter. Or the stock price has maybe some type of short-term meaning. If it's a good high-quality company and you think you're going to own it for the long term, I have no issue buying it ahead of earnings. If you're something you're trying to trade, then you probably want to wait and see what earnings. But if you're going to own this stock, it's a good high-quality company, you're going to own it probably for the next decade, and they report tomorrow, I would have no problem buying it today. You're welcome. Sir?
Why are good companies like Ford and General Electric, for just a couple of examples, doing so bad?
Ford and GE, why are they doing so badly? Well,
Doing so good.
yeah. So in the case of General Electric, right, that used to be the company that was a manufacturer. They said, okay, we want to be a bank. They're a great manufacturer. They weren't so good at banking. So they've gotten rid of GE Capital and trying to shrink that down. That's certainly impacting them. GE had some pension issues with unfunded balance sheets. But those companies have a lot of legacy now issues that they have to overcome. And Ford's really in the same camp. Ford's is more pension benefits for retirees. I give Ford a lot of credit, the only auto that didn't have to take a bailout in 2009. But, I mean, Ford loses money on every car they sell, so they're getting out of the car business, and they're only gonna focus on trucks. But both of them have a lot of legacy issues that's very tough for them. The world has changed, and they haven't. I mean, when you think about Ford, I have a son, he's 12 years old. My son will probably never own a car. Right? Cars sit idle 95% of the time. Young people, they use apps, right? Get an Uber. What do you need a car for? We're starting to see that, and Ford is going to really have to adjust to the changing world. My son will probably likely never own a car. By the time that comes around, they will all be app. And you know, when you think about it, why does anyone need a car if it sits idle 95+% of the time? And Ford's not changing with it. So they're going to have some tough time. And same with GE, sadly. Other questions? Well, thank you, everyone. I really appreciate it. Hopefully, you have me back here next year when we talk about a market that's even higher than it is today.